Yeah, I've acquired 20 businesses at Onfolio, and I usually had to give up equity every time. But going public really unlocked some arbitrage opportunities that most investors don't even know exist.
That's Dominic Wells, CEO of Onfolio, a publicly traded US holding company that buys online businesses. While everyone makes excuses on how hard it is to run a public company, Dom is running it halfway around the world in Taiwan. In this episode, Dom reveals his public company playbook that gave him unlimited buying power.
Before going public, we were doing $1.2 million a year, and now we're on course for about $12 million in 2025.
The hidden risk nobody mentions.
At the end of the day, we're dealing with people. It's all about relationships and negotiation.
What does it really cost to execute?
It probably costs us anywhere from probably about a year.
Dom, you have found an amazing arbitrage opportunity going public, basically able to buy unlimited businesses without giving up equity. So in your one pager, I was going through, you mentioned that your whole strategy is to go public, like use the public status to get debt for a cheaper cost of capital of around 15%, then buy businesses that's generating 20 to 25% in ROI without giving any ownership. So can you explain us like how this strategy actually works?
Yeah, sure. We have our preferred share, which is, it's kind of like a bond, but it's structured like equity rather than debt, but it doesn't dilute common shareholders. So the way it works is a common stock is when you buy a share of Onfolio, and then as Onfolio grows, that share should go up in value. The preferred share, typically the value is kind of fixed, and we just pay a 12% dividend every year. Actually, every quarter we pay 3%, and then it adds up. So what that means is we can essentially, there's two ways it benefits us. One, we can issue preferred shares to investors. So they buy the shares from us. We use that money to buy a business, and it only costs us 12%. And that's good because it's a decent cost of capital. And it's good for that type of investor who's maybe not necessarily interested in sharing in the upside. They just want the 12%. But it's also good because we don't ever have to pay it back unless we want to, because the preferred share is liquid as well. We list the preferred share on the public exchanges just like the common share. So if an investor wants to exit, they just sell it to someone else who comes in and buys. So we just have to pay the interest. And the other reason it's good is sometimes we actually just give that preferred share to sellers. So we've done a business before where I think we needed $1 million. It was actually 1.1 million. And we borrowed 250K just from some friends, basically. And we just paid them interest. And then we issued the seller, I think, 400K of our preferred share. And then the seller was willing to take a note for the remaining 300K. And so basically we bought that business without using any of our own money. And we didn't have to give any equity away because, like I said, the preferred share is technically equity, but it's not really, it doesn't dilute you like issuing common would. And we definitely couldn't do that as a private company because of that prestige that comes with being public, the transparency, and the liquidity of the stock. Those are, really huge things.
If I remember properly, I think issuing preferred shares was probably like first step of the strategy, but your ultimate strategy is to use like non-dilutive financing and kind of like get the like 100% debt and kind of like buy the businesses.
Yeah, and I think as we've grown our revenues, more of that kind of traditional financing has opened up to us as well. But let's say 3 years from now, maybe we're at 50 million revenue. We can probably get debt at 6 or 7% or 8%. So basically we've used preferred shares as kind of a, like you say, the first step, and it helped us get to where we are. And then in future, we'll be a bit more traditional.
What are the terms of these debts looks like if you plan on using them?
Yeah, it kind of varies, but typically you have senior debt and you might have junior debt as well. If you just have senior debt, that basically means that debt is, it takes precedent over anything else in the company. It's like secured against the company. If you don't pay it, the lender can maybe take the company back, that kind of thing. And senior debt is usually lower cost of capital. So it might be, let's say, 7% interest or 6%. And it would probably amortize over, let's say, 5 years. So maybe it's like interest only for 6 months or a year. And then after that, it's just like a straight line. You've got 4 years to pay back that money plus the interest. And junior debt is usually at a higher interest rate, like let's say 12 to 15%, but it's more likely to be interest only, with a balloon payment at the end. And again, if you're buying a bigger business, if it's got more recurring revenue, more consistent revenue, maybe higher margin, and it's generally like considered a better business by the lender, they're more likely to do like a 7-year or an 8-year amortization. The other things that get impacted are, well, how much capital is available, and that might depend on the overall holding company. So, let's say we're a company that's doing 3 million in revenue and we want to borrow 7 million. That's going to be very difficult for a lender to get comfortable with. Even if you're buying a business, which maybe the business you're buying is 10 million, they're going to think, we're not really sure. But if it's the other way around and you're at 7 million revenue and you want to borrow 3 million, then it gets a lot easier. So that it's kind of like, what is the delta between what you want and what you are? And so, yeah, that's kind of why as we scale, like if we're at 50 million in revenue and let's say we're at 5 million in EBITDA and cash flow positive, and then we say, hey, we want to borrow 2 million or 10 million to buy another business, which is going to give us 1 million extra in profit, lenders are going to say yes to that a lot more easily. So yeah, but that's the general like structure.
You have to give some collateral, right? So is it going to be the business you're buying, or is it going to be on the HoldCo?
Usually both. So again, different lenders have different requirements. So a lot of lenders will say, so definitely the business you're buying, there'll be a UCC or a lien on the business. And then if the HoldCo can guarantee that loan, then usually they'll do that. They won't necessarily want the HoldCo and all the other assets to be collateral. Sometimes they will, though, because it depends on your structure. Like, for example, they don't like seeing a lot of capital leave the business when, for obvious reasons. And so let's say you've got a business which is going to produce 100K a month in profit, and 50K of that needs to go to paying the debt and the interest and everything. If we say, well, then we want the other 50K to come up to the parent co so we can use it however we want, then they're more likely to want to have a guarantee on the parent co as well. Whereas if you say, no, that money can stay in the business or it's going to get reinvested into growing the business, we're just going to pay ourselves we're just going to pay the salary of the manager and maybe pay ourselves a small admin fee for the overhead that we incur, then they're going to be okay, and they probably won't want a guarantee on the holding co. And again, it also depends on the size. Like if the business you're buying can't really support the debt, but the holding co can, then yeah, they're going to want to bring that into the picture as well.
Got it. I think it's almost like it's not like a set in stone. It's all about, what the lenders thinks it's high risk or low risk and negotiate on the terms.
Yeah, I mean, there's a lot of, it's about what you're trying to do, who you're working with, and who you are as a borrower as well.
Can you give us a little bit more on, what is the difference you have seen from running a private HoldCo and actually going public? Like, what are the advantages, you have seen when acquiring businesses?
There's a lot. Some of them are intangible. Like, for example, if I want to pitch somebody something, generally typing an email like, hey, I'm the CEO of a NASDAQ listed company, like they're going to read the email. So there's a lot of that. Or you want, not only are they going to read it, they're more likely to say yes, because there's prestige, but there's also transparency, there's corporate governance. So for me, I live in Taiwan, but I have an American company and we do global business. sometimes people are like, what? And I'm English. So like, where's this English guy living in Taiwan trying to buy my business, and he wants to pay 30% of the money later? Like, am I ever going to see that money? And then, oh, you're listed on NASDAQ, you have a board of directors, you have auditors, your banks, I can sue you because all your banks and everything are in the US. Like, then it's not even a question. Then they might think, well, why do you live in Taiwan? But you also get more deal flow. So we get a lot of bankers reach out to us with businesses for sale because they'll Google, like, who is buying businesses, and they'll find us because we do press releases and we have like filings. Usually, one of the advantages, which I didn't really think, is it actually warms sellers up to, like, I don't have to come to a seller and say, hey, I want to pay 4x for your business, and worry that they're going to say, oh, I thought you would pay 8x. Because, like, at first, actually, when we first went public, that happened. People thought, oh, you're a public company, so you're going to pay more. And I would think, well, just because I can pay more, why should I? But now what people do is they just Google our previous transactions and they see how much we pay and how we structure it. So that might mean a lot of people say no, but the ones who say yes, they already know what they're getting. Plus, they can see, this is getting a little bit in the weeds now, but I think a lot of sellers, they're afraid of being taken for a ride or being taken advantage of. And so if they can see, okay, like 5 other people have accepted this structure, they think, okay, I'm not, like, it makes sense to me, but am I being an idiot? They're like, okay, 5 other people took it, so clearly it's like an acceptable deal. So that's kind of on the deal making side. Also, recruiting people is generally easier. And yeah, biz dev is easier. None of it's easy, but it's easier. So it's like the visibility, and it opens, it brings more opportunities your way. So yeah, there's probably more, but I think those are really the key ones.
Basically, like the whole non-dilutive financing and using preferred shares and stuff. I feel like, for this model to work, you kind of have to use a combination of them for it to make sense, rather than, just using like one form of capital. So can you use an example of a deal like, you did, like what the structure looks like?
Yeah, and I think you're right. At our size, you do need to use a little bit. I think in the future, as we're larger, that might not be the case. Or if we're in a different macro environment, you might be able to use more. Like if it was 2020, we could just borrow money, pay no interest on it, and buy a business all cash. But the times have changed. I think yeah. So some examples. So I talked about that one earlier, the 1.1 million one. Another one, we bought a smaller business about a year ago, $600,000. The business was making just under 200,000 profit, so we paid just over 3 times. And it was a very clean structure. So 600K, we gave him 200K cash, and I'll talk about where we got the cash from in a sec. 200K seller note, which was, I think, 9% interest only, and we're going to pay him in 2 years, so 1 year now. And then the other 200K was preferred shares. And so the first 200K, the cash, that one we did give up equity because we raised money from some joint venture investors where we said, hey, we've got this business, it's making 200K, we're selling 30% of that business for 200K. So if you invest, you might earn 30% interest, blah 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 blah. And so basically then, so we only owned 66% of that business, and the investors owned 33%. But again, we were able to get it without using any of our own money. Apart from, obviously, we had legal costs and we had like due diligence costs and stuff.
So when you say interest only for 2 years, like what do you mean? Like, do you have balloon payments, or like do you pay out principals?
Again, it kind of depends what you negotiate. But what we did was it was just interest only, and then in month 24 we pay the balloon. So let's say it's 200K. Keep it simple. Let's just say it's 10% interest. So 20K interest per year, and we would do that in 12 equal payments. So it's like 1,200 something per month, and then you do that every month for 24 months, and then you pay back the 200K. Sometimes we might say to someone, we'll do a short-term balloon payment. So there was one company we bought a few months later. I think they wanted 900K upfront, and then they were going to do a seller note and preferred shares. So the kind of similar structure. But we actually only had 500K, but we knew we could get 400K in like 2 months. So we said, okay, how about we do 500K now, and then we do a short-term loan. We think we can get it to you in 2 months, but let's do 4 months just in case. And then the other part of the loan is like the 24-month one. And I think the first business we bought, the 1.1 million one, we basically said it's a 300K note. Again, interest only for 2 years. And they said, how about after 6 months you pay 100K of that 300K? And we said, how about 50K? So it's kind of a negotiation. And the same is true with the interest, because like if we say 8% to a founder and they say 10%, it's not really a big difference to our cash flow. Like if it's if you're paying 20K a year to someone or 24K a year, it's not really going to make that much difference to your cash flow. So we start low because why wouldn't you? But if they came back with 19%, then we say no. But if it's like 8 or 9, you just kind of, it's just an area of negotiation. But it's basically the key thing is, can you get that interest only component?
When we are at this stage, using with preferred shares and stuff, like as you mentioned, once you grow bigger around that 50 mil rev range, you could use that traditional debt where you can just use 100% of the debt, to kind of do acquisitions. So just to get an understanding, of the strategy, can you give us like one example for that structure, what it would look like? For example, let's assume for simple numbers, maybe a business generating like 1 million in revenue, 250K and let's say profit, and you're buying that with like 100% debt. So what would that structure looks like when you're applying this strategy?
Yeah. So I know this is hypothetical, but yeah, at that size, you would, the seller would, the debt lender would probably want you to put some cash down. Like it might be 10%, it might be 20%, it might be 30%. Some of them will allow that to be a seller note. So they might say, we'll lend you 70% of the purchase price. And some of them say, we want you to put 30% in as cash. And you can then bring in an investor and say, do you want to help us get up to that 30%? Some of them will say, we don't really care. Like it could be a seller note. So the seller just, if it's, let's say you're paying $4 million. If you say, so 70% would be like 2.8 million. So if a lender says, we'll give you 2.8 million, we don't care where the other 1.2 comes from, then you could go to the seller and say, hey, we'll give you 1.2 million up front, or sorry, 2.8 million up front, and a 1.2 million note. And most sellers would probably accept, 70% up front. Some lenders will say, we'll lend you more cash, but you need to pay it back faster. So in that case, there are some people who they'll lend you all the cash and they don't really look too hard at your own financials, but they want you to pay them back like over the course of 12 months. And that can be difficult because you think, well, this business, I'm paying 4 times earnings for this business or 3 times earnings. So the money that's going back to the lenders is going to be higher than the money that's coming in from the business. So in some situations that actually might be fine. Maybe you've got a ton of profit elsewhere. Maybe you're going to double the business in a short period. But in a lot of cases you think, okay, that's not the best for you. So I would say the sort of standard answer that I would give, like based on, what is the actual ideal scenario, it would be a lender would probably lend you 70 to 80% of the cash, and you would either have to put it in 10 to 20 to 30 yourself, or the seller will. So it's always good to have some cash yourself, or to have some friends or investors who can help close that gap.
So at the end of the day, we are dealing with people and it's all about negotiations.
Yeah, unfortunately. Yeah, it's about relationship. It's about negotiation. It's about how well you can sort of explain it's about how familiar they are as well. So a lot of our difficulties are we buy online businesses, so there's no tangible assets, there's no collateral, and the lenders often don't understand online businesses. So if you're buying like a real physical business, like I don't know, like a local brick and mortar business, it's a lot easier. But unfortunately, that's not the that's not the industry I chose. So
even in the beginning of the podcast, I mentioned that. So you are not at a stage where you can use 100% of that debt, like traditional debt. Still, you have to use preferred shares. You also gave us some metric that, hey, you have to be around 50 million revenue and 5 million EBITDA. Like, is there anything else, that you need to have so that the lenders are ready to, like, hey, you have reached this level, so we are happy to, lend you that, like at the rate you're looking for?
not really. I mean, yeah, I think there are things that you need, but if you have that revenue and you have that profit, that kind of suggests that you have all those other things. Like ideally, you have a track record, you have maybe 2 or 3 years of operating history. Sometimes you need to have been profitable for 3 years. Sometimes you don't. That really depends on the lender. So I would say, yeah, there are other things, but if you have those metrics, then you almost definitely have the other things as well.
God, I mean, so it's let's say if someone bought 2 big businesses and then making 50 million revenue, do you think it still qualifies? Or are they like, hey, you got to have X number of acquisitions, or so you've done it multiple times?
No, I don't think that matters. I think how long you've held those businesses for would matter though. Like, let's say you bought those 2 businesses, and then 1 month later you went out to a lender and said, hey, this is my revenue. I've just bought these businesses. Can I have capital to buy another one? They would probably want you to, at least the better lenders, like the ones who give you the better structure and the lower interest rates and so on, they would probably say, come back in 6 months so that we can see that the business revenues are still good under your ownership. Some lenders won't care. Like, what you can do is buy a business, take a revenue-based loan straight away against the business, and then you're fine. Like, I know some people who are well known in the space, who you know as well, who bought a business together, and I can't remember the details, but I think they bought the business for about 300K, and it was making a ton of revenue. So they took a loan against the revenue and immediately paid themselves like $2 million in dividends. And they've probably taken $4 or $5 million out of that business over the years. And because the revenue is so high, they were basically able to, they didn't worry about growing the profit of the business or the business being profitable. They just used its revenue to pay themselves a big dividend, and then the revenue and kind of profit of that business paid back the loan over time. So there are some scenarios where, yeah, you could probably buy a business and almost immediately leverage the fact that you own the business and you've got its operating history to get more money, but it's usually going to be more expensive capital than, like, if you do it how I just said.
Yeah, also I've seen, at the smaller level, I have seen people trying to use revenue-based financing and stuff. So when I did some numbers, I'm like, how are they even going to pay back? There's almost no margin. There's no like margin of error for if they make one mistake and they're not able to pay the loan back.
Yeah, it usually works better as part of a structure, because usually revenue-based, they'll lend, like, I don't know, let's say a business is doing $1 million revenue, they might lend 300K. If they lend $1 million, then they're probably going to want to get paid back very quickly. And yeah, like you say, then like it's not gonna pencil. It's not gonna actually be able to cash flow. So you could say, well, we'll take a revenue-based loan for 300K, and then maybe a seller note for 400K, and then like some cash kind of or something.
Like, you got to use a combination of them for it to make sense.
Yeah, exactly. Yeah.
Got it. Now it makes sense. Okay, so you said that for the non-dilutive financing, like the lenders have like a specific type of businesses they are like happy to lend to, and then there are specific type of businesses, let's say online businesses, which is they're more skeptical about. So can you tell us more about like anything there, how we could maybe position it as like especially online businesses?
Yeah, I mean, it really comes down to, does the business have any collateral? So if the business dies, can the sellers get paid back? The lenders, can they get paid back? And usually online business doesn't have collateral. E-commerce does, so e-commerce usually finds it a little bit easier, and SaaS finds it easier. So that, which brings me to the second point. The other thing that they look for is really the strength of the revenue. Like, how robust is the revenue? How reliable is it? So SaaS is funny because they have recurring revenue, and they can, like, technically you can cancel a SaaS anytime. So in theory, the revenue it's not like people are signing 1-year contracts for most software businesses, but you can see you've got 1,000 customers, they pay every month. Maybe you lose 4 customers every month, but you're gaining 4 or 5 every month. So those lenders feel a lot more comfortable, and they'll typically lend a larger amount. And there's more things available. Like, there's more companies out there who will fund this type of business. What's harder is if let's say you have like an agency business or a digital product business that there are all these one-time sale, there's no recurring revenue. The other thing they look at is customer concentration. So maybe you've got 15 million revenue, but 10 million comes from one client, and that client doesn't have any contract or anything. Like, they could cancel tomorrow. So they're really asking themselves, what's the risk for us? So if the business, how likely is the business to die? Like, okay, it's got recurring revenue, you've got thousands of customers, people usually stay for 7 months, you don't have a very high refund rate or churn, and it's very consistent, very like smooth revenue. There's no seasonality. Like, that is generally good, and they understand software businesses. Whereas if you're an agency that might get paid like $300K by one client in January and then nothing again until the following January, and then you've got some other clients spending some money here and there, and meanwhile you have expensive contractors who are doing all the work, and one of your clients is 30% of your revenue, another client is 20% of your revenue. They're going to look at this and think, this is quite risky. So they might not lend to you at all, or they'll lend you less capital, or they'll lend it to you, but they'll have like a more aggressive payback schedule. So it's kind of a whole combination of things they look at.
Yeah, I think at the end of the day, everything boils down to the risk. You have lower risk, you get better terms. You have lower risk, the buyers are willing to pay more for a business. Like, everything is boiled down to the risk.
Yeah. And the thing with lenders is, and you get this with anything from like, say, Stripe to or PayPal to huge lenders, is that typically lenders are very conservative at first and then very greedy later. And they'll say that as well. So it's not like an insult, but like, in the beginning, they're like, we don't want to lend you any money. We're going to lend you a tiny amount of money. It's going to be quite expensive. But once we know, okay, you're a good borrower, you're going to pay on time, your business is growing, or it's not dying, then they'll usually lend you a lot more money and better terms. And it might only take 4 months before they come back with more. And so it can be hard as a borrower because you're like, I don't know if I trust you. Like, I don't want to take this capital from you because it's too expensive. And they'll be like, yeah, but we'll give you more in a few months. And you're kind of like, well, can't you just give it to me now? So it's just their philosophy is like, once they have someone that they like and they trust, they'll throw a lot more money at them. They'd rather do that than like write lots and lots of checks.
Real quick, guys, each of these episodes represents over 30 hours of my personal work, not including my post-production team's time. I'm building this podcast to become the number one resource for business acquisitions, and the only way that's going to happen is through your feedback. So please drop a comment with a timestamp for the parts that you found valuable or not helpful. If you're on audio platforms, you can leave a review. This will help me understand like what you like, what you don't like, so I can create exactly the content you want to see. Thanks for your support. Now back to the podcast.
Now we talked about all the pros and advantage of, going public and use this all kinds of financing. The next question is like, what are the risks that could like blow up the strategy?
I think it's just more expensive to go public, and you have more people just watching what you're doing, commenting on your performance. You have like the stock performance can distract you, or it can excite you. But I mean, if we're talking about the negatives, there's more. I guess you move slower as well because maybe you need to ask the board of directors permission to make an acquisition, and sometimes an acquisition, like the opportunity comes up, you need to move quickly. I wouldn't say there's more risk. I think there's probably less risk as a public company because you have a lot more lawyers and people around you, but it's just more expensive. So it can be more difficult in the beginning when you're like a small company like we were.
You have been giving out dividends for, I think, I forgot the exact number, consecutively, without missing a single payment. So the question is, let's say I want to look at the two sides. So one is, let's say you have given out preferred shares, and then there is, let's say you've got some debt, with the lenders and stuff. So what happens if you default on those payments? Let's say first with preferred shares, and let's say second with when you have financed it.
Preferred shares, I mean, we're not obliged. Well, we're obliged, but the reason preferred shares are different from bonds is if you default on a bond, the bond holders can come after your business, and depending on what the terms of the bond are, that was going to look differently. Preferred shares, we actually can stop making dividend payments. The board has to approve it, but we can stop making it. Now, we wouldn't do that because that will basically kill our ability to use preferred shares in the future. So to answer your question, we've paid preferred shares for 2020, 21, 22, 23, 24. So 5 years, 4 quarters, and Q1 2025. So 21 consecutive quarters we've paid preferred shares. If we paused, if we said to investors like, hey, we can't pay you this month, but don't worry, we'll pay you next month or next quarter, just doing that, even if we then go pay them next quarter, just doing that is like, it makes it a lot harder to raise more preferred share capital because people are going to be like, wow, you're giving me this thing that says you're going to pay me dividends, and how do I know if you're actually going to pay them? So that's the real downside. But there's no, like, if you don't pay the dividends, they can't come and sue you or anything. The other advantage of preferred shares is if the business, if you go bankrupt, preferred shareholders get paid first before common shareholders do. So you sell off all the assets of the business. Let's say there's $3 million in preferred shares, and there's I don't know, there's common shares as well. If all the assets of the business get sold off, the first 3 million goes to paying preferred shareholders, and plus any dividends that have been missed, and then common shareholders just split whatever's left. But yeah, there's no like recourse, whereas debt usually there is, and it really depends on what you negotiate, like how good their lawyer is, how good your lawyer is. It could be that they just come after that business. If you just took debt on that business, it could be they can come after that. They can basically get access to all of your businesses, and they can sell them or take them over.
So with the debt, interest percent is going to be locked until the term number of years, or they can say, hey, we are changing it or something like that?
It just depends on what's negotiated in the beginning. So once you've signed the deal, like that doesn't change unless you both agree. But what killed a lot of businesses, like a lot of the Amazon aggregators, was they took debt that was called variable debt. And so what that basically means is if interest rates go up, then your debt payments go up. And so SBA loans are like that as well. There were a lot of people that bought businesses in 2021, 2022. They probably paid too much for those businesses because everything was going up in 2021. And maybe the interest rate they were given was 4% or 5%. And so they're like, wow, this is great. This business is printing money. I'm only paying 5% interest. And now we get to 2025 and, well, actually most of those businesses are dead. But 2023, interest rates went up. So now instead of 4%, they're paying 11%, plus they have to pay back the the actual principal, and the business has declined. So now instead of like them making 30K a month and their interest payment's 5K, maybe now they're making 15K a month and their interest payment's 12K. So like it gets a lot more difficult. So yeah, like it's not like the bank can come back and say, hey, your interest is gone up now, unless like that was what was pre-agreed. So yeah, it basically, now we always are just like, look, it's 12% or it's 8% or whatever. We pay you in monthly payments, and then in month 24 we pay you back the full amount. And if we can't pay you at any time, this is what happens. Like usually you have like a 60-day period to make the payment. And it's still a negotiation, because maybe you say to someone, hey, we can't pay, which means you're going to have to sue us and take the business back. Or we can just renegotiate, and maybe they want to renegotiate. It depends who you borrow from, and if there's a good plan. Like if they think, yeah, okay, I can see you've just had a bad month, then they'll be fine. But if the business has died, maybe they'll come after you more aggressively. So basically, to kind of answer your question, it just all depends on what is agreed upon in advance.
What happens, if you have another recession and somehow, all businesses stop, generating the same amount of revenue and profits? I think it's just negotiation. You just sit in front of them and just negotiate. Hey, this is the terms, we could do now, or something like that.
Yeah, it's just it depends. And if you have flexibility, like if you've put a UCC, which is kind of like a guarantee, if you've put a guarantee on your business and you need to go out and raise more money, maybe you can do it, but the person that has the guarantee, the UCC, has to agree. Whereas if you have only put the guarantee like on a subsidiary and you need to raise more money to pay them or something, you have that flexibility. So it really depends what situation you get yourself into. And hopefully most people never have to worry about that.
Do you think every holding company out there should be going public?
I think every holding company can benefit from going public. I think whether they go public or not is down to individual preference, individual style. A lot of holding companies will benefit because they'll have access to cheaper capital, more acquisitions. They'll have a higher valuation. Like, let's say there's a business that does 10 million in profit. As a private company, what's that worth? 50 million? As a public company, it's probably worth 100 million or 200 million. So you just get a higher valuation. And that's true like at the smaller levels as well. Like a public company that's growing might trade for 20 times profit. And so if you're buying businesses at 4 times profit, that's a pretty good arbitrage. But some people don't like being public. They don't like the scrutiny. They don't like the quarterly earnings. They don't like having a board of directors. They don't like having to be transparent about what they're doing. And I don't mean that in like a negative way, but some people, maybe they've got like a secret playbook they don't want other people to know about. Some people just prefer to stay private. There's a lot of big companies out there that are still family owned and stuff, like Hermes, the luxury retailer. They're a holding company, I guess, in some ways, but they're still family owned for like 200 years. So there's a lot of it really comes down to personal preference, but there are definitely advantages to those who decide that they want to go that way.
So what are the main reasons why there is a huge gap in the valuation if the company is private or public? Is it because like transparency, low risk?
That's one of it. Liquidity is one as well. Transparency, corporate governance, and liquidity as well. Like if you buy a Berkshire Hathaway share, you can sell it tomorrow. If you buy a private company share, you might not be able to sell it. So there's that. More people can invest, like generally speaking, in public companies. Like it's a lot harder to invest in private companies. You might need to be a accredited investor, or you might not even have the opportunity to invest. And then also, like, it's just generally accepted that public companies have a premium, so they tend to earn that premium. But yeah, those are the main reasons. It's like the transparency, the reliability, and the corporate governance and the liquidity.
Compared to when you were running a private HoldCo and now you're running a public HoldCo, do you think your lifestyle has improved or like went down?
Well, both. I think it depends. I think my lifestyle has improved because the company's grown, so it's like we were at 1 million revenue and now we're at 12. My salary's doubled through that period. And so I'm wealthier, my net worth has gone up. So my lifestyle has improved. But at the same time, it's probably more stressful. Not all the time, like right now I'm in a good place. The company's doing well. Like I'm not stressed. It's also more exciting. So sometimes it's like, it'd be quite nice having a private company and just being able to relax and ignore what the stock market is doing and stuff like that. But it's just really hard to compare because when we were a private hold company, we were so small and so new. We went public so early. It's really hard to actually have a comparison because yes, like things have got better and like richer and so on, but it's like, well, that's because the company is bigger. It's not necessarily because it's public, but then maybe it's bigger because it's public. So it's hard to give a definite answer there.
Like, do you feel pressured, to get that good quarterly results?
More when we first went public. Like we've been public now nearly 3 years. Nearly 3 years, and the first few quarters were like a lot more stressful. Now, if we have a good quarter, I'm kind of like looking forward to sharing the results. If we have a bad quarter, I'm like, well, whatever. Well, it depends. Like, why is it a bad quarter? Do you think there's a serious problem, or is it just like, like we had a bad quarter? But it's because typically when you're sharing the results, you're already halfway through. Like we're not going to report Q2 until 45 days after Q2 closes, which means you're basically halfway through Q3. And so there might be an example, I still have to be careful what I say now, but like there might be an example where Q1 was bad, but you're already halfway through Q2. Q2 is crushing it. So you kind of have to write this thing like, you might be like, yeah, Q1 sucked, but we'll make, but Q2 will be better. And shareholders might be like, oh no, like, are you okay? And you're like, what? Like you're 45 days behind. And so it can be tricky, like before we went public, I thought public companies could share more because like, oh, hey, we're public. So we can talk about our revenue and we can talk about our profit, but there's way more things you can't talk about. It's like, you can talk about this thing, but not yet. Like, I can't talk about April until September. It's like, so it's very, public companies have to be more private sometimes. It's really weird.
I think it's like if you're public, you want to be private. If you're private, you want to be public. So there's the advantage, disadvantage.
Well, before I went public, I asked one of my advisors who was thinking, like I was like, should I talk to some other public company CEOs and ask them how do they feel about it? And he said, you can, but the answer you get will depend on how well their stock is doing. So if their stock is up, they'll say, yeah, man, it's great. If their stock is down, they'll say, don't do it. And I was like, that makes sense, but that's not particularly helpful.
Like, do you think it has impacted your decision-making process?
Not really. Like, I think it impacts your patience more, and your patience may impact your decision-making. Like, I typically I have quite a long time horizon, like maybe I think 10 years in advance. But of course, I also think like 2 months from now as well. But you want to get results faster. Like you're making a decision thinking, okay, if we do this right, we might have a really good Q3, but you kind of want it to be a good Q2. So you might think, should I try and buy this business in June so that like I have all the profit in July, and maybe and then you find yourself rushing it. But once you've kind of been public for like 6 or 7 quarters or like 2 years, basically, you kind of are aware of that mindset, and you can kind of stop yourself doing it. So it's just about getting used to, I think.
How many hours do you think you're spending your time with, the investor relations, the other things?
At the moment, not much. But when we first went public, I I did it a lot because I wanted, like, I wanted to tell the story about the company. I wanted the company stock price to go up. I wanted, all these things to happen. Whereas now I'm like, I kind of have more of a mentality of like, well, just focus on the results and the stock price will take care of itself. And maybe I've done that too much, and now I do need to, like, I have shareholders emailing me like, can you tell the story more? And I'm like, well, yeah, or I can improve the story. Like, what do you want me to do? So
yeah, probably I think that is one of the reason, like most of the podcast I was like, when I was doing research, was like when they asked for the story, they're like, yeah, I mean, it's just the same thing, I've done it before. I think you kind of like got bored of telling the same story so long.
yeah.
But
when people say to me, why did you go public, I'm just like, I can't even remember anymore. I can't be bothered to tell you. But it's like
makes sense. So like, what about the audits, compliances and stuff? Like, do you still spend any time on it, or is it like the team handling everything else?
I spend time on it, but I probably spend the least time on it than like a lot of the other management. It's really the CFO's job and the accountants and the team. I write the kind of I write the earnings press release. I write there's a section of the filings called the MD&A, which is management's discussion and analysis. I usually write that. So most of what I spend my time on is, when it comes to an audit, usually, like, I might have to answer some questions. Like, the auditors are like, can you explain what this payment is? And you explain it. And sometimes they're just testing, because part of their job is they'll pick transactions at random and ask you about them. And like, do you have supporting evidence? You're like, yeah, here you go. And they're like, okay. And then if they are not happy with an answer, or maybe you don't have the supporting evidence, then they'll expand their testing, and now they have to test more transactions. So like, let's say they test 20 transactions in a particular sequence. If they all are above board, they might not test anymore. But if one or two of them, they're like, you may have booked that wrong, maybe now they'll do 100 questions. So where I'm often involved might be someone saying, hey, do you know where the invoice is for that? And I'm like, yeah, it's in my inbox, let me go grab it. Or they might say, was this payment for marketing or was it for software? That kind of thing. And then I review everything that the auditors do, or the CFO does. So when we get our legal filings, they might be 40 pages long. So of course I go through it and I look for typos, and sometimes we miss typos, but you want to make sure the numbers make sense and the description of events makes sense, and just all of that. And then, like, you have meetings with auditors. So the board, because the board represent the company, but they actually represent the shareholders. So the board have to ask the auditors, has management been good? Have they responded to your questions on time? Do you have any suspicions about them? And then the auditors have to ask management, do you have any do you suspect anyone in the company has done fraud? And you're like, no. And they're like, okay. This is like all these perfunctory questions I have to ask. So it's a lot of, it's just, it's just a thing I have to do now. People are like, oh, that sounds awful. And I'm like, well, it does. But like, tidying your room sucks as well, but you have to do it.
In the longer run, I think this could be solved. Maybe you put a CEO in place, like replace yourself. I think Tiny did it recently.
Mm-hmm. Yeah, Tiny hired Jordan.
Yeah, I think, have you thought about that? Like, down the road, just put a CEO in place where you could handle all those things.
I've thought about it, and I've thought about, I live in Taiwan, so we have to have like a what happens if China invades thing, and so like who would step over, and at the moment it's not something we would entertain. Basically, if there's someone out there who would do a better job, who the company could afford, who would have the same growth impetus or more than I did, yeah, maybe it makes sense. Or maybe like I'm 50 years old or I'm 60, then yeah, it makes sense. Right now, where the company is and where my vision is and my competence and my aptitude and my desire, like, it makes sense for it to be me. But maybe one day in the future I step into a chairman role. Maybe I promote someone to CEO, or we hire someone. I think where we're focusing first, really, though, is like building out the sort of management layer below me, which is either the managers of the companies that we own, because we've definitely chopped and changed around there, or like kind of a layer above them, like the kind of like support level. Like I think Tiny did it. I don't know whether Andrew didn't want to run Tiny or whether he just felt like someone else would be better. Whether it was a desire thing or a competence thing. But like they brought Jordan in, who was at Constellation Software for 10 years, 20 years. So like clearly they thought, okay, he's gonna, he's got the experience and he's gonna lead the turnaround. So yeah, I think it comes down to desire.
How many hours are you spending right now per day just handling, running the business, handling the compliances and stuff?
Probably more. Like I've got 2 young children, so probably not more than like most people would do. Like, I've definitely done 10-hour days, 7 days a week, 12-hour days, 7 days a week before COVID. Now I probably, I start work at 9 in the morning. I finish at say 4:30 to go get my kids from school, and then because of the time zones, I'm usually working at like 10 p.m. till maybe 11 or till midnight. Like because I'm 12 hours ahead of New York, so I might have a call with someone like 9 a.m. New York time, which is 9 p.m. here. So, maybe I do an hour less than people during the daytime, but then I do a couple of hours in the evening. So what is that, like a 40-hour week, maybe 45-hour week? So it's not like I'm doing 60 hours, but it ebbs and flows as well. Like if we have something that we're working on, and we need to ship something quickly, we'll pull in more hours.
Knowing what you know right now, do you think you would have gone public? If you had to do it all over again, do you think you would have gone public at the same size you went public?
Maybe not. So that's interesting because people usually ask me, do you regret going public or would you still go public? And I would usually say, like, I don't regret it. I would still go public, but I would do it differently. And if people say, well, how would you do it differently? I'd probably say I'd do it slightly bigger or slightly more profitable first. And yeah, I do think some of the problems we had in sort of 2022, 2023, and maybe the first part of 2024, which we're coming out the other side of now. So it's like not a problem anymore, but we're still like working through it, is that basically we went public too small and we weren't profitable. If we'd raised more money or we had lower expenses in the beginning, or we were just larger, we probably would be further along than we are now. But at the same time, like, I don't think we would be where we are now if we hadn't gone public. So maybe we wouldn't even be around anymore because we were really focused on content sites before we went public, and like that business model died. So would we have been able to adjust if we hadn't raised money and bought different types of businesses? So, it's hard because I don't have a counterfactual. But I think in an ideal scenario, yeah, we would have been like maybe slightly more profitable, or like had 1 or 2 more acquisitions under our belt first.
What do you think is the right size? And let's say someone is running a HoldCo. I think, hey, if you're doing at this much revenue or profit, I think this is the best time for you to go public.
I don't know about the best time, but I would say ideally you're going to be doing $1 million profit a month, a year before you go public, because then you can absorb the costs and you'll get all of the benefits and few of the downsides if you've got $1 million a year in profit. Whereas we had we were losing money when we went public. So, timing helps as well. Like if we'd gone public 1 year earlier, maybe we'd have raised more money at a higher valuation. But maybe we'd have bought businesses that died a year later. So, yeah, I think timing, and I think also you need to be in a position to benefit. Like some companies, if you're an acquisition company, you can go public and grow very, very quickly. Others, it's like, well, what you're doing, being public, isn't going to accelerate you. It might slow you down. So maybe the timing doesn't work for you. I think it all comes down to that.
Like, how much does it normally, cost to run a public company at this range?
The cost has gone down for us. Like, ironically, over the years, as our revenue's grown, our cost has gone down because our insurance got cheaper. our insurance is probably 100K a year cheaper than it was when we went public, because the further you get from the IPO, the less risk there is of shareholders suing you, and the market's improved, and just stuff like that. But overall, I think it probably costs us anywhere from probably about 750K a year. But I think when we were doing a lot more investor relations and going to conferences and all of these, like, we probably spent more like over $1 million. It can probably cost, I'd say, between 500K a year and like $1 million. It depends how big you are, though. Like, a lot of companies, their audits are going to cost $2 million. And that's just the audit. So yeah, it really depends.
What about the cost, when, let's say, while setting it up and stuff? I think it's like a completely different cost, or?
It probably cost us about 500K to go public, yeah. So it was about 500K before, which was basically the investment bank. I think they needed about 50K retainer. Lawyers probably cost us 50 to 100K.
Like a year or a month?
Total. Like, yeah.
Oh, total.
Like, so it was about a 7-month period.
Okay.
The audit cost about 200K because they had to audit 2 years. And that was probably it. Yeah. So maybe it cost a bit under 500K, not including so like when we IPO'd, we raised about 13 million, and like 8% of that went to the investment bank.
Going public helps you get this leverage, build your wealth, but also at the same time, it comes with all this, other things you have to take care of, spend time on. At the end of the day, is it worth it for you personally?
Not yet, but I'm building. Yeah, like, I think in a few years' time, I'll look back at this period and be like, yeah, like, where we are today is I can draw a straight line from that to like where we are now. To where we are today. I mean, not then. So I think it will be worth it. Will it take 1 year for that? Will it take 10 years? That's the question, and that's what people who want to buy our shares kind of have to ask themselves as well. But at the moment, it's like we've been building. We're kind of at a point. An advisor said to us the other day, he said, "Oh, it looks like you've turned the corner." And I said, "It's not really like we turned the corner. Like, it's more like we were underwater and we've just come up." And people might say like, "Oh, you've come up. Well done." And you're like, "You've just seen me breach through the surface, but I've been swimming for like an hour." So you might not feel like you turned a corner. You might feel like it's just been a long journey and people only see the results. It's like when someone makes it to the NBA, it's like, yeah, but you didn't see the 15 years going through it. So we're at the point where, like, we're putting the reps in and building the muscles, and we've laid the foundations, and now we're building on that. But like, we don't have the fruits of our labor yet, but that's fine because we don't expect them yet. So it's hard for me to give a yes or no answer, and it might sound like I'm just trying to, trying to cope. But that's generally what I feel.
I think you just have to live in the future. That you know where you're going, and you just gotta focus on that rather than just looking at all the ups and downs that's happening every single month. Awesome. Yeah. I think. Yeah. Also, I was thinking, like, oh, if I when I start my HoldCo, should I go public? Should I not go public? It's hard. I think it's just personal. You got to decide like what you want, and then decide based on that. It's not like like a straight answer.
Yeah, 100%.